Good morning, everyone. My name is Muge Manga. I work with FSD Kenya. I'm part of the Green team. And we're here today to celebrate Kenya and also look at the opportunities within Kenya on green finance. We have a fantastic session today that will include a presentation from PwC on what we're calling the Green County Preparation Facility, which was launched by FSD Kenya. And we will also have a fantastic panel with speakers from Mpesa Africa, Blue Orchard Finance, and PwC and FSD Kenya as well. So, green finance in Kenya. What is it? Where are we? Currently, Kenya is receiving about $1 billion a year in green finance. 15% of that is going towards resilience adaptation, and the balance is going towards mitigation. There's a lot of work that needs to go in terms of lifting this number. From studies that have been previously done, we are going to require up to $60 billion to have a successful green transition in our economy. We need to build resilient infrastructure, we need to create green jobs, we need to upskill our people, and all this is to say that we need to create a sustainable and green future. Part of what we're doing at FSD Kenya, which was launched in 2005, is to see how we can create market systems that work and that will actually catalyze and can be lubricative in bringing in this green finance. Today, we have the pleasure of being here as well with Lilian Bergman, who is the Investment Director of British International Investment, BII, that is also part of the FCDO Toolkit for Development, and I could say that we are cousins in some way, one form or another. And she will also speak to the project that they're doing. And the reason for this is because we're seeing that the physical space within governments in Africa is closing. And the need for embracing what I call the 4 Ps, public-private philanthropic partnerships, is going to be more critical, because public money alone is not going to be enough to see the dreams that we need to achieve. And therefore, working with private sector, mobilizing private sector capital is going to be extremely critical. As you will see in the presentation from PwC on the Green County Preparation Facility, we have several projects that are quite exciting that are on the sub-national level. As you know, Kenya has 47 counties. And these projects we are positioning to actually receive private sector funding, be structured in a way that are bankable, and enhance the readiness and the preparedness of these projects. This is our goal, and we believe that we will continue to achieve this goal. So with that, I would like to welcome Lilian Bergman to have some opening remarks from BII. Maybe we could have a round of applause. Thank you.
So good morning, all of you morning early birds, and welcome to the Kenya Investment Summit organized by FSD Kenya. I'm Lilian Bergman. I come from the British International Investments, where I'm an investment director. When it comes to BII, we have been investing across the region for more or less a 75-year-long history. We're part of the British Development Initiative. And today, our portfolio in Kenya is a good mix, a vibrant mix of everything from private equity investments to financial services, startups, and of course, renewable energy and clean energy. We are part of the UK sort of Kenya Investment Summit today, and we have quite a few business partnerships which sort of are growing between the two countries across a range of sectors, including the sectors which we are talking about today. So for today, I was asked to talk about green and inclusive financing and the DFI's role in this sector, what sort of investments we've supported in Kenya. I would say DFIs, BII in general, over the last 15 to 20 years, have had a mandate to support climate sustainable investments. And these target sectors and markets and technologies have changed, and they keep on changes. But one thing that sort of still remains throughout these changes is that DFIs have a role more than ever to catalyze private money coming into these investments. On our end, what we've done, we invested in Malindi Solar back in 2018. It's a 52 megawatt solar project, and it was one of the first independently owned utility-size solar plants in Kenya. It is now complete and fully operational, and it is connected to the national grid in Kenya. On another level, and maybe more recently, BII has engaged in a JV together with Matita Utilities called Africa Water Infrastructure Development. And we just signed, as a part of a larger consortium, a PPP with the Kenya Ministry of Water and Sanitation to advance the development of bulk water treatment in the Naivasha region. And this is an interesting project for us because it actually started as a privately initiated proposal, and that has now resulted in a 30-year-long cooperation in Kenya. DJV, Africa Water Infrastructure Development, have done a similar successful project in Kigali, where we operate a water treatment plant as well under a PPA since 2021. Now, we still need to continue to work in this sector and continue to try to catalyze work together with both governments and with private sector to make the renewable and clean energy sector as big as we need it. So I think today we are seeing a few opportunities coming to light in Kenya, and we would like to see more of them. Proposals growing from concept, building up to a proper investment, and then being operationalized through partnership. And FSD Kenya and PwC have done a lot of work to sort of scan the market in Kenya to see what sort of opportunities there are out there. And I think that's the most important part and most interesting part of today's session. So with that words, I will let us actually, the group of people who are interested in these businesses coming up, potential projects, to see if we have something which we can support. Thank you.
Thank you. Thank you very much, Lilian, and thank you to the BII team. You're doing fantastic work on the continent and not just in Kenya. At this moment, I'd like to invite Jotham from PwC, who has been on the ground. This is a man who has been running up and down all these 10 counties. You will see from the sweat on his brow that he really is no joke. And so if you want to get the real deal of what's been happening, Jotham is your guy. So he will do a presentation on the Green County Preparation Facility. And we have projects totaling about 50 of them, almost over $1 billion in transaction value. So these are quite serious projects and very transformational, the answer to a lot of the SDGs that we are also trying to achieve as a country. So I would like to welcome Jotham onto the stage from PwC, who are assisting us as technical assistance partners. Thank you. A round of applause.
Thank you, Muge. Morning, ladies and gentlemen. Yeah, so the work that we started with FSD Kenya is work that is part of the Green Finance project that's currently being supported through funding from FCDO. Part of the support that Muge alluded to earlier from the UK government. And ideally, when we started this work, it was phase 2 of what had already been started in 2022, which was a green finance assessment across 10 county governments, which are equivalent of municipalities in other regions. So there are 10 county governments in Kenya looking at various regions. So we have a couple of counties to the north, that is Wajir County. We have a few counties in the Lake region of Kenya, that is Kisumu and Kakamega, no, Kisumu, Vihiga, and Nandi. And then we have a couple of counties in the central region, looking at Laikipia, Kirinyaga, and then one county in the coastal region, that's Taita Taveta. And the idea was to have a good balance of the country, but also to appreciate what are the unique characteristics across the county. So then the assessment looked at 4 areas. That's economic and fiscal assessment, how these counties have been performing in terms of their revenue generation potential, and looking at how they're servicing their debt and also their own initiatives to sort of fund their budget. We also looked at their green asset potential, which is essentially looking at what are some of the assets that these counties have. So your rivers, your dams, looking at other assets like public infrastructure through which then various initiatives can be funded. There was also an element on capacity, a technical capacity assessment. And the question really was, do these counties have enough capacity in form of skills, in forms of people that can run with some of these initiatives? And lastly, also, we did a credit assessment, which at the time, the objective was if we could float some green bonds to fund these initiatives. So out of this engagement that ran over 2 years, there are a couple of outputs that are very important to this phase. One, we indeed confirmed that counties have capacity, which needs, of course, to be strengthened to run with these initiatives. Two, there were a couple of initiatives that were identified in form of areas that counties had prioritized to address their sustainable development objectives. And then three, and which is most important to this conversation, is indeed we had a list of projects at the time, which was really a wish list, that the counties then were desirous to invest in these initiatives to address both their climate change issues, but largely also their socioeconomic development objectives. So we have a couple of projects that I'll speak through, and essentially what you see on the screen is just an overview of what had been done previously and what we're building up in our current phase. So if we look at what is on the screen right now, it's really just an appreciation of what this facility is looking at. So the facility essentially is providing technical assistance to this county government in a number of areas. One is to select a list of viable green projects which address both climate change issues, but also contribute to sustainable development. There's also a strong element on helping these projects to get to investor readiness, and I'll speak more about it. And then we also have an activity where we are supporting counties to engage various funders to get some of these projects funded, and largely also facilitating discussions both at national level, at county government level, and other stakeholders such as yourselves. So ideally, that's how we are structured. So we have FSD Kenya as the funder, PwC as the technical advisor, and of course we had other partners on board. So what have we done? So since we started this work, we have sort of originated in another words is to mean we have a list of projects that we believe are a priority to these counties, but also that you can participate in terms of investment. So we have about 59 projects across the 10 counties at various stages. So we have prioritized about 10 projects that are currently going through the project preparation activities. So we've got feasibility studies happening, we've got structuring of the deal, and we've got investor engagement going on. So that's essentially the three areas where sort of our activities are focused. And just an overview of where we are to date. So each of these counties sort of have a structure through which they are able to engage various stakeholders. So we have the county green investment working groups, which are these structures that we believe can also sustain these projects beyond our duration of support. I've already spoken to some of the initiatives we've done, and ideally at this stage is to find ways in which we can collaborate to further develop these projects to a level where they can be invested in. So this is just an overview of what our pipeline looks like. So like Muge mentioned earlier, quite a huge pipeline. So various tickets, but cumulatively we are looking at around 400 million USD across the 10 counties. So these projects are at various stages. Of course, we have those that have already gone through the feasibility study and project preparation process, but also some that need support to get there. If I narrow down further, so in terms of our pipeline, where are we seeing a lot of investments? So water and sanitation is a key area, and this is looking at both the bulk water systems, so enhancing your supply of water, down to the treatment facilities, but also the last mile connectivity. So you will see in our portfolio that we have quite a number of projects that fall within those areas. Connected to that is sanitation, both your liquid and solid waste management. And then outside of water and sanitation, we have renewable energy, a couple of water and solar. An example is a 100 megawatt facility in the northern region of Kenya. So the area has very high solar installation levels, and we believe that is one that if we invest in, it can really spur the economic development in that region. We also have agriculture and livestock. Again, a couple of value chains that have been identified. We've got livestock. We have various crops such as macadamia down to the coast. And then we have smaller aggregation centers and facilities that, looking to enhance exports, but also to contribute to economic development within those regions. And then a couple of projects in the public infrastructure space. So your public health facilities, your transport systems, etc. So this is just some of the areas where we've seen a lot of our support, a lot of our projects are really coming up. So these are the sort of the two ways in which we can support these projects. So one, like I've said, a number of these projects will require support to get to a level of investor readiness. And really is to say, if it's a water project, what sort of support is required to design them in the most efficient way. So we need support in terms of the technical design, the feasibility assessment, structuring the deal, etc. And then on the other hand, it's funding for implementation. So we've got various avenues through which the projects can be supported, either through grants, debt, equity, a couple of instruments really that you can plug in. So we have a QR code through which you can access some of these projects. Well, I've not confirmed if it's working, but I'll be able to share the list of the projects with you to have a look at. So if you look at the AFSIC deal book, we have about 7 projects that we've listed. So if I may very quickly just highlight some of these projects. Just give me a second. So under rural water system, so we have projects which are essentially looking at IoT and technology. It's working? Okay, sorry. Right. So we have got a number of projects looking at rural water systems, about $2 million kind of investments. We have both a borehole and smart taps connected to these systems. And we have these projects down in Taita Taveta and a couple of other projects across the central region. We also have some projects that we've listed on liquid waste treatment facility, which you will see in the deal book, about a $20 million investment. Ideally, this is to address your urban sanitation challenges. So again, a very promising project that you can look at your own free time. Then we have solid waste management, and then we have mixed-use roadside park down at the coast. Just an example of some of the projects that we do have. So we really believe that these counties have the potential to actually, one, attract investments and provide the right regulatory environment for these investments to thrive. And I believe that the people in this room, and by extension our various partners, we can really work together to attract the right investments that address both climate change challenges and issues within the counties, but also to spur economic development. So let's engage further. We are happy to provide more information on the same. Thank you.
Thank you, Jotham. And so as you've heard it, we're definitely looking for partnerships. There's a lot of opportunities. We do have projects that are hitting the right IRR, and we welcome partnerships in that. Now we're going into our panel discussion. So I'd like to welcome my colleague, Sarah McKenna, who we work with together in the Green Finance team, who will be moderating this session, to come up. A round of applause. I know it's early, but...
Good morning. First, I want to apologize because the QR code that was put there is not the one we intended to show. We intended to show one that takes you to the projects he's alluded to. So this is what I'm going to do. I'll give you my email address now. Then you can share with me your email. You can send me an email. And what I will do after this is share with you that list. We have it ready somewhere. We just had some confusion. So my email address is Sarah, that's SARAH, .McKenna, the way the name is not Njero, but McKenna, that's MAKENA @fsdkenya.org. So after this, I'll find the emails and we'll be able to share with you the deals that we have and what we are doing, the details of what we are doing. So I will be calling up my panel, and we're hoping to have a very interactive session this morning. And like my colleagues have said, Jotham and Muge and Lilian have mentioned that we have potential in Africa, and that's what we have been speaking about every other year. But the other good thing is there's a lot of progress that we have seen. We may have gaps, but we've had a lot of progress over the years. But what we want to do is move a step ahead, and that's why the projects like what we are implementing right now exist. So the panel this morning is going to go a bit into what have we done, what are the missed opportunities, and what next for green financing. So we'll be calling up my panelists. I have 3 panelists this morning. Eric, welcome to stage. Hannah and Angela, welcome. Thank you. All right. So I will allow them just a minute to introduce themselves. I'll begin with you, Angela. Tell us something about PwC and what you're doing around green financing, and introduce yourself. Thank you.
Thanks, Sarah, and good morning all. My name is Angela Kanina. I'm manager within the transactions team. I actually sit in the Nairobi office. And outside of the work that we're doing with FSD Kenya around the preparation facility, I support a lot on anything to do with mergers and acquisitions, corporate finance, project finance. We also support in feasibility studies as well. So I think the goal for us is to get the capital going where it needs to go. We have seen a lot of projects both in the private and public sector spaces, so looking forward to having conversations around this. Thanks, Sarah.
Thank you.
Hi, everyone. I hope you're all well today. My name is Hannah Kihenjo. I take care of savings and wealth management at Mpesa Africa. So what we're looking to have a discussion on today is how we've been able to support green finance in the country, and additionally also look at exploring with you all some opportunities that could come up on green finance. So looking forward. Thank you.
Thank you.
All right, good morning, everyone. My name is Eric Onyama. I'm a senior investment officer at Blue Orchard. Blue Orchard is an impact asset manager based out of Zurich, Switzerland. In Africa, the office is in Nairobi, where we cover the entire continent, and our focus is on supporting financial institutions to lend to impactful sectors. Thank you.
Thank you. Thank you. If you know any Kenyan, one of the things that we're very proud of is Mpesa, and we're moving continental, and that's one of the revolutions that has existed and supports not only green financing, but has been very revolutionary in ensuring that we have the levels of financial inclusion that we have. So that's something that we will also be discussing as we continue with the conversation. So I'll begin with you, Eric. And one of the things that we see is there's always a mismatch between the demand and supply side of capital. So you will have capital providers always mentioning and saying, we have the money, but we do not have projects to invest in. And especially right now with the buzz and conversations on sustainable finance. And so I'll want to hear from you, what has been one of the challenges or some of the challenges and key barriers to mobilizing capital for green MSMEs and climate resilient value chains that you have observed, and how do we overcome this?
Okay. To start off, I think that times the challenge is the size of the businesses that we come across. So you find a business, it's profitable, but then its scale is quite small. So for example, when you look at Blue Orchard, we look at ticket sizes between $1 million to $10 million. Getting businesses that can absorb that volume of capital at times becomes very difficult. So it takes time to try and scale up these businesses before we can engage with them. But in the meantime, that's why we try and work through financial institutions to try and support these smaller institutions. But then again, when it comes to now commercial banks and their ability to be able to lend to these businesses, at times the reality is, when you look at these banks, at times they do not even know that they're lending to green businesses just because of how the management information systems have been configured. And at times you have to go in and show them, oh, by the way, you're actually doing green businesses. But then because of that lack of awareness, when you come in as a green business and say, okay, I have this business opportunity, this is how I'd like you to support me, at times they just shut down and like, okay, we don't work with such types of businesses. So just being able to show them that you're already doing this, all you need to do is just reconfigure how you look at businesses, and there actually is an opportunity in green businesses. At times when you look at some of these founders, they get so caught up and so excited about the mission, they forget profitability and longevity. And you come, you're trying to do a deal with them, but they're trying to sell you the vision, but they can't sell you the business case. And that becomes a difficult conversation to have. Like, yes, we can see the vision, but for us, we manage private money and we need to give our investors a return. So until you figure that out, then we can't partner with you. So that sort of friction also hampers our ability to be able to provide capital to some of these businesses. I think another issue I'd mention is, at times you get a business, yes, it's well structured, it's profitable, and it's in the green space. But then the challenge becomes that it's not due diligence ready. So for example, they have no governance structures, they have no defined ESG frameworks. So now we have to provide technical assistance before we can provide the investments. And these businesses need this money urgently. So if you can't deploy it at the time that they need it and you want to give them technical assistance, like, okay, no, let me go and look for funding elsewhere before I can come to you. So there's need to still build the capacities of these businesses so that they can become more investor ready. Thank you.
All right, thank you. Hannah, M-Pesa, like I mentioned when I was beginning, has been very revolutionary in terms of just innovation around many innovations on PEGO models in Kenya and even beyond. So we've seen innovation around M-Pesa and even integration with banks, etc., that has happened. And one of the things that we keep hearing is the role that M-Pesa has played in terms of increasing savings and increasing the amount of investment. So how are we leveraging this platform to mobilize savings and investment for green investments? Is there any initiatives that M-Pesa is involved in or in the pipeline to mobilize savings? Yes.
Thank you, Sarah. So M-Pesa as a payments platform, also enabling savings, investments, insurance, and so forth. First has been able to come in from a payments perspective. So when you look at rural, hard-to-reach areas, that some of these customers are looking to then participate in green finance, are looking to, as an example, Mkopa, are looking to buy a solar-powered light to be able to have energy and light in their homes. So if you're looking at how they can be able to be included in the financial system, then that we have been able to do that through M-Pesa for payments. So rural hard to reach areas, like someone in Lodwar who's trying to get a solar-powered light, someone in Turkana who's trying to get water irrigation coming in through a company like Sun Culture are able to make those payments through M-Pesa. So while it may look obvious, of course, in developing countries where these networks have already been created, the fact that these hard-to-reach areas are provided for in our country, Kenya, makes a whole difference. So from a payments perspective, that we have been enabled to do. The second thing we're looking at is financial inclusion, because going back to the Mkopa example, we're seeing that the customers are coming in and they are looking at buying either solar-powered lights, or they're looking at solar irrigation in the example of Sun Culture. And how they're able to do this is using a pay-as-you-grow model. So you pay every day or you pay every week, depending on how you're able to. Now, for this particular one, then we are seeing financial inclusion coming in because they're able to save up to be able to buy these items. So that's the second piece that we see. The third piece is on agriculture. Agriculture is the backbone of the country. It's the biggest sector that we have. So enabling farmers to be able to engage in green finance, especially off-grid finance, is something that we are very proud of. So in those three areas, we have seen M-Pesa play a significant role, and especially on providing access to hard-to-reach areas. And we've seen that impact make customers who would have never dreamt of attaining some of these off-grid facilities do so.
All right, thank you. We've heard from Eric on the investments in terms of why we are not investing, and Hannah is telling us about the opportunities and how we are reaching the hard-to-reach areas. And to you, Angela, we have been talking about the private sector. I believe Muge mentioned it, Lilian did, and that's our goal with the project that we also are partnering with PwC, that we need private investments to come in to fill in the gap that we have currently with the exchange, the exchequer in Kenya. And so one of the things that we've had challenges with is preparedness, and we have that, and like Jotham mentioned, one of the challenges that we have experienced with this preparation facility is, as you can hear, we have 50 projects, but what we are presenting in terms of saying this is what is ready for investment are not the 50 projects, but the counties presented to us more than that, meaning there's a phase that we need to come in even as private sector to support. And Eric was mentioning, yes, everyone wants the money, but we are not ready. So what role can the private sector play in terms of that pre-investment phase of investment?
And thanks for that, Sarah. And maybe just to repeat again, I think the role of the likes of FSD Kenya and where you've come in the investment cycle is very critical. I think looking at sources of capital that come to prepare the investments, almost fast capital sort of structures that are almost willing to lose some money to get some of these projects and products or businesses to a certain level before getting investor ready is quite important in the large scale of things. Two, and maybe not to belittle what Eric was saying, maybe it's to get a balance of what commercial return and social return looks like. I know private sector, of course, the goal is to get the money to make money. Return is the goal. But I think in the grand scheme of things, if we will not give commercial returns a backseat, is to also see the role of the social returns that come as a result of the commercial. So it's for private sector to also look at it through that lens. Three, I think largely through this facility that we're working on with FSD Kenya and largely in the other things we work on. Stakeholder education, I think, has been very critical. Working with government, working with sub-government as well. You find the players within this ecosystem are not all on a level playing field. So I think stakeholder education is key, and I think private sector plays a key role in that as well. And also bottlenecks in structuring some of these projects. So whether they come in from a private sector or government level, getting the right structures in place from the beginning is critical, and I think private sector and all the actors in it will be critical in getting that in place to get the private sector funding flowing. Yeah.
Right. Yeah. Okay, thank you. I want to first make this a bit interactive. So I don't know whether we have any questions before we proceed to the next round of discussions. If we don't have any question, we'll still proceed and we can have an interactive session towards the end. So I'll come back to you, Eric, and we've seen our commercial banks and other financial institutions playing a critical role in providing financing. And we've also seen reporting, and like you've mentioned, you mentioned at the beginning, to say our financial institutions do not even know sometimes that this is green lending they're doing. For them, what makes sense is, how does your balance sheet look like? Does it make financial sense? And that's when we are lending. But what, looking ahead and looking at the solutions, what do you see local financial institutions and investors' role being in terms of advancing green financing and being very intentional because these are things that we cannot ignore anymore. We have to be very responsible with our lending, go beyond the balance sheet and go beyond the IRR to see what does it mean for me to do responsible investment. So what is the role that financial institutions, local financial institutions will play?
Okay, I think the role of financial institutions and especially commercial banks is very critical. We can have all the impact investments that come in, the donor support that comes to somewhat de-risk some of these investments. But at the end of the day, for us to be able to build a proper green economy, the banking sector is at the heart of it, and it has to do it very well. The challenge, especially we're talking about Kenya in particular, when it comes to lending, provided green financing opportunities are competing with bonds and corporate lending, the green case will always take a backseat. And for me, I feel that this is where now regulation comes into play, where you have a very alert and well-informed regulator that appreciates the importance of green financing and economy and supporting and ensuring that, yes, that we are able to transition into a proper climate-resilient economy down the line. And they could easily legislate and say, you know what, we expect all banks to dedicate a certain proportion or a certain quota of their loan portfolio towards green businesses. And I think when it comes from a regulated standpoint where you must comply or face consequences, that now forces banks to now become innovative and come up with ways of being able to figure out these green businesses, build the pipeline of green businesses that they can lend to so they can be able to meet these regulatory requirements. So that's for one. And just to go back to the initial question around why perhaps why green businesses are struggling to get capital, one thing is that there's really not much information in terms of how well these green businesses are performing. So we know, we have these lights, like you hear of Mkopa. Mkopa is really massive. And that's a unique case. There are much smaller businesses that are doing critical work that still have the capacity to be scaled up and become more impactful and create more jobs. But because we have no idea how much they have grown without any sort of commercial capital, or what sort of difference they're making in terms of job creation, or what sort of commercial capital they've actually attracted, and what sort of exits have been achieved. Lack of this information makes it very difficult for investors and for banks to become excited about it. I think there's also room for, I call them mid-net worth individuals. So rather than high net worth individuals, now middle net worth individuals. You and I, who can be able to spare $1,000 a year to be able to put money into these green businesses. We do not have avenues for that. And I think if we had more public data around how these businesses are doing and there are vehicles that you can deploy this capital into to be able to support such businesses, then we can be able to get more local capital supporting such enterprises. Yeah.
All right. Okay, thank you. I think this will set a good platform for us to go to you, Hannah, and ask about the innovative digital products. And we've spoken about Mpesa, and maybe you need to say a few words about Mpesa and how that has worked and changed much in terms of access to finance for the lower income groups. And so what are the innovative digital products or even partnerships that we've seen M-Pesa exploring to integrate climate and green? So we can speak to those innovations and also what else? I know Safaricom also launched the sustainability report, meaning you're not only, and I'm mentioning Safaricom because it's very much related. So there is a lot of intentionality to ensure that green businesses are being embedded. So you can tell us a bit about that.
Okay. So thank you, Sarah, for that. So like you rightfully said, Mpesa Africa is 50-50 owned. So 50% Safaricom, 50% Vodacom Group. And both of our parent companies are very intentional about ESGs, about the impact, playing a part of fulfilling the SDGs. They're very intentional as to support sustainable businesses. They're very intentional as to provide not only payments, but to explore some partnerships that can be able to come in and provide a great boost to green finance. So that's number one. Number two, when you look at, going back to what Eric said, when you look at the numbers, it's very clear that sustainable business is not only a passionate project, but also profitable. When you look at the volumes going in, and especially the volumes, the number of customers that are engaging in green finance solutions, and then also additionally, the amount of money that's going in, it's not an area that you can be able to ignore. When you look at M-Kopa, like you rightfully mentioned, over the last decade plus, they've been able to have 5 million customers. These 5 million people in the mass market, what are they getting from M-Kopa? It's solar-powered instruments, and then also additionally, they're able to pay slowly on smartphones. And when you look at the paying slowly for the smartphones, you'll see that it's most of the customers, it's their first time getting access to a smartphone. It's their first time having access to a smartphone that can enable accessibility to further green finance. So as far as that is concerned, we've seen a huge, huge impact. When you go to also another example, Sun Culture, you'll see that smallholders, small-scale agricultural holders are the ones coming in to be able to buy their first pump, reducing their water needs by 80%. That's a huge, huge, huge reduction. And we're seeing that they're coming in, they're picking the solar-powered pumps, and they're able to fulfill not only needs, the food needs for their families, but also additionally they're able to have a surplus and sell around their areas. So when you look at that, you see the real impact, because for Sun King, it controls 50% of solar-powered pumps in sub-Saharan Africa. So that's the kind of impact that's there. And therefore, M-Pesa Africa, enabling this through M-Pesa through 7 markets, that's DRC, Kenya, Ethiopia, Tanzania, Mozambique, Lesotho. We see a huge, huge impact on that. So again, I think what we need to do is to highlight the stories better, is to talk about what's happening and make people aware that this is something that is already happening. Therefore, all the partners, all the interested parties will be, all the stakeholders can come in and see a part in which they play on that. So back to what Eric was saying, it's important that we tell our stories right, because a lot is happening.
All right, thank you. One of the other things I must mention is what has happened through the PEGO models that Hannah has alluded to is to allow people who would not have accessed that financing to access it and at their own, at interest rates and at levels that they're able to repay. Because when you look at the informal settlements, for example, or some of the rural areas in Kenya. The incomes are not regular, but you're able to provide a platform and also provide an innovation that allows them then to access products that they wouldn't ideally access without such innovations. So Mkopa, Sun Culture, and many others, we're just mentioning the few that are associated with M-Pesa, have really revolutionized how, what does it mean to have access to financing? What does it mean to have access to even these innovative products that we have? And that takes me to you, Angela, and what I'll want to hear more from you is what are the other sectors, looking at the projects that you're implementing at PwC, what we've been working on, and even the macros and how the situation that we find ourselves in the country, what opportunities do we have, and what sectors do we see great opportunity in terms of investments in green? I think Jotham mentioned a few of them, and now you can take this opportunity to talk about the projects, the bulk water projects that we've seen, and why is this important?
Yeah, thanks for that, McKenna. I think from where we sit, given I sit in the Kenya office, we largely do support the region. So that includes Kenya, Tanzania, Uganda, Rwanda, Zambia, and Mauritius as well. So we have a view, especially in the transaction and deals team widely, of what's happening in the region. And I think Hannah has mentioned a lot of the success stories are not really publicized or spoken about enough, but I think there's a lot of deals happening within the region. Within one, for example, the infrastructure space, Kenya, for example, we are seeing the first privately initiated transmission line that's being done in Kenya, in the western side of Kenya. So that's one that's really big and is going on currently. I think they're almost at close. So on the infrastructure side, because of the fiscal limitations within the government and the book, we are seeing a lot of private sector play coming in there, especially in the power. So that's transmission. We have a lot of private sector, of course, in generation. Distribution, not so much. That sits with the utility provider. But one, infrastructure and energy is one big one. That's in Kenya. Uganda as well. There's a lot happening on the hydro side. That is very good to see. And of course, with, for example, the lifting of the PPA moratorium hopefully coming soon, then we will see a lot of drive into the sector, especially on the private sector side. Two, manufacturing, I think, is also a big one. With the spaces we're seeing, the special economic zones, the EPZ zones, Kenya specifically as a hub for regional exports into the other countries, I think, is a space we're seeing a lot of movement happening in the logistics space as well. So we do expect things to keep growing on that end. Three, we have been seeing a lot of interest in the education sector, interestingly. We have had a lot of conversations with interested universities and tertiary education from the US, from China. So we're seeing a lot of interest coming into the region from an education perspective. So also a sector we could probably keep an eye on for anyone who wants to flow money into the region. Kenya specifically, financial services, I think, keeps being the sector that keeps giving. I think recently one of the maybe notable is the securitization of the Kenya Roads Board that saw a lot of interest from DFIs. Interesting things happening there. TDB as a lead arranger, of course, with other banks as well. So we will keep seeing a lot of these innovating products coming into the financial services sector. And I think Kenya does largely remain a hub for flow and two very strong professional services here. Maybe to speak to Uganda, we have seen a lot moving on the mining space. Telcos as well, key in Uganda as well. And like I mentioned, within the power sector, we are seeing a lot of movement in the energy side. Tanzania, the LNG is attracting a lot of interest. And of course, tourism remains a key one for Tanzania. Zambia, given I think the space they are within the mining sector and the current challenges they're having in having enough supply for the power, I think also remains a key investment platform for Zambia as well.
All right, thank you, Angela. And before I come back to you, I want to go back to you, Eric, and now to specifically speak to international investors like yourselves, and to really understand what role can the investors, now we talked about the financial institutions, but there's this gap that every day I'm sure you're waking up and wondering, where is my next deal coming from? So what role can you play in this transition? What do you think that all these international lenders and financial institutions need to do and play a part in the green transition and being intentional about the investments that you make? And you can speak to any that you would be comfortable to talk about the investments you may have done in Kenya or in Africa.
All right. So when it comes to us as international investors, I think beyond the capital, I think providing technical assistance is very critical. And this goes beyond paying for conferences and networking events. I think there's more to be done in terms of being able to embed people within some of these institutions to just build their capacities when it comes to how do you appraise a green business. I think we can also be able to enroll and encourage more banks to come in with us on some of these investments. For us, we are not at the infrastructure level, so we're not doing macro level investments at this micro level. Sometimes you get an institution just needs $1 million or $2 million, but you're like, we can do this on our own, but it would be even more valuable if we can get 2 or 3 commercial banks to collaborate with us on a particular investment deal so that they can be able to see, okay, this is how we look at it, this is how we appraise the risk. And because we are, especially for the Nairobi portfolio, we are private debt, we are like commercial banks, so we are likely looking at the same risks. Our capital might have different tenors, but in terms of appraising the risks, we are more or less identical. So I think being able to collaborate on some of these investments could be seen both as technical assistance, as a way of hand-holding and telling banks, this is how you do it, how you do this. But at the same time, we can also be able to provide some affordable capital, maybe perhaps not for Blue Orchid, but as a way of incentivizing banks to be able to lend to some of these green spaces. So for investors that have more concessional financing and they are able to provide some of this capital to banks to onward lend to financial institutions so that they can specifically support green businesses, that's another way we can be able to support that transition.
All right, thank you. Thank you. Before I come back to you, Hannah, I think I want to again come to Angela and ask you about other avenues for investments that we've seen that could crowd in financing from the private sector for green. We've seen efforts within the green bonds policies in Kenya. And my question then would be, what opportunities, as you do your transaction advisory at PwC, what other unique opportunities are you seeing for innovative financing for the sector? We've seen green bonds, we've seen green REITs coming in. What opportunities? And Eric mentioned and said that it will continue being difficult if we're going against the public bonds, the public paper that we have right now.
Yeah.
Thank you.
Thanks. Yeah, I think one, the private sector capital we've seen in Kenya, and probably just to mention the pension fund, which is very huge. They sit with a lot of money, but they're very risk averse. So like I was mentioning earlier, education, stakeholder education will be critical in getting and unlocking some of this money into the different sectors that we're seeing, including, for example, the green projects that we're trying to prepare. And largely because, for example, the capital markets is also a bit limited in terms of what is offered there. I think we also need to sit back and see, for example, the money sitting within the private sector, what do exits look like? So the role that FSD is playing in helping the capital markets think through other innovative solutions. 3, what else could I say? So stakeholder engagement and education, growing the capital markets, I think those are 2 large ones. Yeah.
All right.
Yeah.
Okay.
Yeah.
Let me come to you, Hannah, and I'll almost relate it to what Angela was speaking to. M-Pesa sits with access to almost more than 3/4 of our population, and we've seen the innovation. So, based on where you sit and the opportunities that you see, what what can you do in terms of partnerships with other sectors that we have already seen you doing it? What do we see? Is the government, do we have the right policies? What is standing in between M-Pesa and us seeing more and more innovation coming to the market?
Okay. So when you look at policy, I would say policy has been geared towards supporting green finance. When you look at even reporting, the company reporting, especially for those that are listed, you'll see that there's a push to be able to report what we're doing for sustainability, what we're doing for the environment, what we're doing to promote financial inclusion, what we are doing to enable those who are in green finance. So from a perspective of reporting and from a perspective of policy, the last couple of years especially, we have seen a push to be able to have those conversations and also report sustainably. And that's why, like you mentioned, there was the sustainable report that came from Safaricom just the other day, outlining further details on that. So I think on that front, there's a lot of traction that has been made the last couple of years. With regards to how do you partner, of course, partnering with entities that have been doing this for a very long time and are able to get onto the ground and see exactly what's happening, and they can be able to give you the factual story about what's happening on green finance. I think those two, in terms of reporting and in terms of partnerships with the right companies, is what will make a great impact on green initiatives.
Thank you.
Yeah.
Thank you. I want to first ask whether we have any questions on the ground before I give my panelists an opportunity.
Thank you.
We can hear you.
Thank you. Good morning. My name is Kojo from Ghana. Thanks for the insights. My question is, how are you mapping out these opportunities to take advantage of the carbon markets? Thank you.
Thank you. Thank you. Do we have any other question, or do we pick that first? Angela, I would want you to, do you want to attempt that, or do I ask Mogwe?
I'll ask the question as well.
Okay.
I think as you ask the question, you could come and respond also to...
Oh, okay. So I'll ask the question then. So my question was maybe if you could speak around the difference between perceived risk and actual risk.
Yeah.
Because I know also, Eric, you've been speaking a lot about that. And the conversation around Africa is, it's too risky. Don't even go to the airport. But what is the actual risk on the ground? What is the failure? And maybe you could just touch on that so we could get more clarity on what the cost of perceived risk is. Yeah. In terms of the carbon markets, which I'll pick up, as you know, the carbon markets is going through a transition. It's not been an easy year because most of the market is moving towards the compliance market. The voluntary market prices have, for lack of a better word, collapsed. And so many countries are seeing how can we position ourselves to take advantage of the compliance market. For Kenya, as FSD Kenya, we've supported the government through the Climate Envoy's office in developing the frameworks and also building capacity to take advantage of the demand and the supply side. And what we're finding is that in spite of signing of bilateral agreements, particularly with the 3 S's, Sweden, Switzerland, and Singapore, and you're from Ghana, so you'll be familiar. Ghana actually was the first to issue compliance credits, so congratulations. There's still a challenge in developing the whitelist because the NDC, which is basically the development plan for the country, dictates where the carbon dividends are going to be coming from. And so for a country, you need to be very clear where you want to play and how you want to play. Is it going to be e-mobility? Is it going to be clean cooking? Is it going to be nature-based solutions? Is it going to be tech-based solutions? And this is something that the country is still mulling over. where do they want to see the right areas of development of carbon credit capital going in. In the voluntary market, we've seen a lot of action. Kenya was the #1 carbon exporter in Africa for the last 5 years, pre-2023. And so we've performed well. A lot of entrepreneurs are in the country doing carbon projects. But now with the movement of the compliance market, it's slightly requiring some lubrication to now get the government to say where they want to see the projects enter. So that's where it is. So in terms of a mapping, we do see tremendous potential across the board, but we look at carbon credits as a subset of development finance. And so if it can be incorporated into the balance sheet or into the financial model of a project, it will do so. So I'll stop right there. I've spoken a lot. You can see I'm very passionate about credits, but that's where I would stop. Thank you.
There's a question there.
Thank you very much. My question is very simple. How about the double income treaties in Kenya, which are small? I mean, there is not a lot. I think 10, 12 double income treaties signed with Kenya around the world. This, as an international investors, this is very important for us because we look at a country where we can not be taxed twice when we do investments or returns.
All right, I will let first Eric respond to the first question from Muge.
All right. I had this on a panel yesterday that Africa's risk is mispriced and therefore all its assets become mispriced. So it's very costly because you imagine the number of businesses that lose out on these on funding opportunities because of misperceived risk. In my own experience, it's very interesting. So we have offices in Singapore, in Peru, and in Georgia, covering Central Asia. And many times whenever we take deals to our portfolio managers for their consideration, you look at two institutions, they're identical in everything. The only difference is the geographical location. And the portfolio manager tells you that I cannot justify this price to an investor in as much as the institutions are identical. And at times it's a difficult situation where the original investors who now provide, whose money we manage, would perceive Africa being a much higher risk. But given that they're impact investors, then they should be a bit more open to invest in such opportunities because of the impact potential. The impact potential of doing something in a market like Kenya would surpass the impact potential that you would have, say, in Vietnam because of the scale of the need. And you already have more local capital financing opportunities in a market like Vietnam compared to Kenya. So the capital that would come from Blue Orchard to an investment in Kenya would be more catalytic compared to what would happen in a more developed market like Vietnam. But at times these are some of the constraints that we have to work with. But yes, more needs to be done, especially now when it comes to the owners of the capital in terms of just their willingness to be able to look at risk slightly differently. But then again, it is really good that this realization is happening, and you have not the African development, but rather the African Union advocating for us coming up with our own credit agencies because the big four, the big three, are somewhat misperceiving or mispricing the risk on the continent. And yes, there's all politics around why this is the case, and I don't think I should get into that. But I think just the realization that yes, the risk in Africa is always made to seem worse than it actually is. And this has been costly in terms of opportunities that go uninvested in.
Right. Okay, thank you.
Yeah, I'd like to just add on to that. Muge asked about actual versus perceived risk. And maybe at a project level, one, there's a project risk, and most times investors are wondering, then for example, the solar project that Jotham was talking about, who's the off-taker of whatever service or product is coming out? So I think if you think about some of this, especially from a project level, if you think through one, the project risk, two, the political risk, and of course the credit risk, and then put in structures in place to actually then protect the investor, then of course things becomes a bit more attractive. Maybe on the perceived risk side, and especially what we're seeing on the any projects that touch on government, one, there's largely a negative sentiment because of course of what has been going on, and two, a lack of trust. But I think what the public sector and government are doing now is that they're involving private sector a bit more and putting them in the room when these discussions are happening. So for example, anything to do with PPP right now, you get a lot of private sector transaction advisors coming in to help you structure and think through the process end to end. So on the actual risk, I think we have a way forward as private sector. On the perceived risks, I think we still have some way to go, but I think we're getting there. Yeah.
Yes.
And maybe if I could add, another way of managing this perceived risk is just through what Hannah and I have been relaying about telling stories and just being able to demonstrate that capital is deployed to this particular project, to this particular institution. It delivered a decent level of return, and we need to put out more of these narratives out there so that the perception changes.
Yes. Yeah. All right. I think, sorry, I can see there's a question, but I wanted to allow you to answer that question. Ask the question, then Muge can respond to the gentleman's question.
Thank you so much. Good morning. I'm Sasha Lightborn. I appreciate your comments and want to ask a question about the preparedness and the readiness of these various projects. So the African Development Bank estimates that annually about 170 billion is needed across the continent for infrastructure type projects. About 68 to 100 billion are actually funded, so there's quite a shortfall. A lot of, well, some of the reasons for the shortfall pertain to what happened during COVID. Another big reason for the shortfall is the readiness of projects. So that can present some risks, as a gentleman here spoke to us a little while ago. That can present some risks for investors. How is Kenya addressing the project readiness, moving from the concept phase to the readiness phase fast enough so that the country can demonstrate to investors that, look, we are mature enough to take on the funds, execute on these projects, and minimize risk?
All right. I think I will have Angela respond to that as the mic comes to Muge, who will respond to your question. Angela, yes.
Yes. Yeah, thanks for your question. So through programs like what FSD is running, where the likes of PwC are supporting project preparation, one from a technical assistance perspective, but also trying to ensure most of these projects are commercially viable. So for example, we went into the market and found more than 50 to 60 projects, but some of them, like you rightly said, are at the concept level. So no preparation has been done. However, I think yesterday I met a gentleman from GET Invest. I don't know if you have GET Invest. So they work for different DFIs and commercial banks, for example, and come in at an advisory level and help some of these projects and developers essentially get ready in preparation, but already have the potential funders in place. So once the projects are ready, then they have the funding that come in place and they find the projects prepared. I think our ask now is of funders to get more into the project preparation, and this is why we're here largely. We have 2 or 3 priority projects that are going through preparation, and I think Jotham spoke about them earlier, and we're happy to provide more information around those. But our ask of the private sector is also to consider, like you said, there's a lot of preparation that needs to go and get done before some of these projects are ready. 2, we're having a lot of policy and regulatory changes, not only at national government, but also at the county level, where we're trying to support these projects. We have a lot of political buy-in from the different counties and national government as well. So I think that plays a huge part in preparing these projects. And of course, like we said, private sector coming in. So help the likes of PwC and our other players in the market coming in to help structure these projects. So then by the time we're asking for the funds from the market and doing a lot of the market sounding, then we are essentially ready for this project. But a lot of the back-end work is being carried out now. Yeah.
I think the question was on bilateral agreements for tax treaties. Oh.
The gentleman.
That was a different question. Yeah. Sorry, did you have a response to that?
No, I thought you were responding.
No. Just going to the previous question. So you are right. There's not a lot of tax treaties that have been signed. I think the most recent one Kenya has done is with Mauritius on the double taxation, and it was killed at one point. But the government has also implemented different fiscal incentives. So, for example, if you want to come and set up a manufacturing plant, there is the allocation of the special economic zones. They also have tax incentives in there. There's also the Nairobi Finance Center that has also been established. So if you do register within those confines, there are tax incentives. So there may not be any double taxation agreements that are robust enough, but there are tax incentives and fiscal incentives that are in place depending on what you want to do. Now, tax is a very big conversation. It's a conversation beyond even the continent. It's a conversation that has also been brought to the G20, in that how can we then close these safe havens that are hosting a lot of this money that ought to go towards services that are going to help the general population. So it's something that is ongoing as a conversation, but as a country in Kenya, there are those tax incentives within the confines of the law and the regulations to attract investment. But at the same time, it's a balancing act because we need the taxes, we need the revenue to basically meet the day-to-day needs of our people. Thank you.
All right. Thank you. Thank you. I see our time is almost up. So I want to take this opportunity to thank you for participating in this discussion and to say that we are available to provide additional information about the projects that we all are working on and trying to also gear up support for. So especially the preparation facility, I totally agree with you. We've gone to the ground, gotten our hands dirty, but we've also seen that there is a lot of support that's coming from the DFIs. And I feel it's from the learnings that we have gone, put money in projects and realized that these projects are not really taking off. And the preparation is what we realize we are getting wrong at that point. Because we go to the counties, we can tell this is a viable project based on the little information that we have, but we've not gone in to understand what's the commercial viability, because we are having a sustainability discussion. So we do not want to go to support the counties and these businesses are not able to take off without our support or the support of any other development institutions. So I think we'll end it at this point. I'd say thank you and continue interacting with us. We have a booth that's inside room 3. You can find us there throughout the day, and we can provide you with any additional information. Thank you, Eric. Thank you, Hannah. Thank you, Angela, for indulging me in this conversation. Thank you.